All right, we're still in March, and now we will record our credit card transactions. So we have purchases, some toners for our laser printer from online market. All right, all of this to me is office supplies. There is no need to dissect it any further. So what's happening? Our liability goes up because we funded you because we're using it to purchase some office supplies. And our office supplies expense right here goes up as well, and expenses go up when debited. There it is, debits and credits are in balance. This amount right here is a debit to 64,900, and this amount right here is a credit to 22,100. Next, we're purchasing some webcams. We can probably book that into computer equipment. Again, arguably somebody could say the amount is small, we could expense it. If we have the profits that allow us to write it off in that year, the bonus for 79, we can do that. It doesn't really matter. What we want to show you is there's different ways to book things, and most importantly, understand the impact on debits and credits. Okay, so let's book this one as computer equipment. There it is, debits and credits, right? This is a debit to account 16,000, which is an asset. Assets go up when debited. And this amount right here is a credit to account 22,100. Why? Because it's a liability, and liabilities go up when they're credited. And that's what's happening. We're buying some equipment that goes up, equipment goes up, and we're funding it with liabilities. Therefore, liabilities go up as well. Okay. Some office supplies. All right, so again, same thing. Liability goes up, expense goes up. Expenses go up when debited. Liabilities go up when credited. We finance this expense with liability, therefore expenses 64,900 went up and 22,100 went up. We bought some professional library items, some guides. Okay, professional library. There it is. All right. Again, what's happening? Liability goes up. Assets go up. Professional library is an asset. Therefore, it is debited to go up. And then 22,100 is a liability. Liabilities go up when credited. Right? Assets go up when debited. Liabilities go up when credited. Two things happen. We purchased some guides for our professional library. Therefore, our asset professional library went up. And we funded it with credit card. Therefore, our debt, our liability went up as well. All right. So then we bought some food items. To me, that's office supplies. Okay. Office supplies is 64900. All right, there it is. Save new. Again, this is a debit to 64900. This is a credit to 22100. Other supplies for the office, like tissue, paper, and to me, again, that's all office supplies. So similar. Different items, but the impact is similar. Expenses go up, right? And for them to go up, they're debited. So 64,900 is debited. And we purchase those items, we finance those expenses with liability with the credit card. Therefore, 22,100 is a liability account. It goes up when credit. All right, we're buying some equipment just like we did previously. We're going to bundle it all and it's going to go all under computer equipment because kind of, we're basically purchasing a couple of laptops, monitors for them, docking stations, so on and so forth. So again, to me, those are all packets of computer equipment. And it's only there. Computer equipment. Okay, let's put them out right here. All right. So right here we can say to lab. All right, there it is. Liability goes up. We know that much because we haven't spent any of our own money yet. And then equipment goes up as well. Equipment goes up when debited, and liabilities go up when credited. Very much similar, again, different type expenses. Sometimes are funded with liabilities, sometimes equipment doesn't matter. What matters is with debits and credits have to equal each other, and we need to know what's being debited, what's credited, and you know precisely what's being debited, what's being credited behind this interface. Again, this amount right here, this amount right here is a credit to account 22100, and this amount right here is a debit to 16,000. 16,000 is an asset account. It's computer equipment, and assets go up when debited. Okay. All right, buying some furniture. Very much similar. Right, online market. This number happens when you're booking and stuff. Furniture. All right, and this is office. You could argue that the surge protector, for example, is not equipment, is not furniture, right? Should we break it out? Yeah, I guess why not? So here it is, our breakout sheet. Let's do our mathematics here. So this way, we don't put the surge protector in there. So 1458, 358, 75. Okay, these two are together. And then we have 8960 plus 152.24 that we have to allocate. this is divided by sum of 3. Yes, and then this is divided by sum of this 3. Yes. So this will get 5% of it. So $12. All right. So we're going to do 75 plus 12. That's going to go into our office supplies. 7. That's surge protector. And then the remainder of it, which is 203,284. Again, doesn't have to be precise in this case because again we need to be approximately correct for tax purposes more than anything else. There it is. All right, so let's go back and adjust. So turns out only $19,045.84 go towards equipment. I mean towards furniture and equipment, and then 64,900 can be put towards office expense because those items may not last. Again, why I decided to break it down is to show you again both assets and expenses on the same booking. Both assets and expenses go up when debited, and we paid for these items using our credit card. Card is a liability, and liabilities go up when credited, right? So debited go up, credited goes up, right? So again, we have some expenses, we have some furniture that we bought, we paid for it with debt, therefore debt goes up, expenses go up, and furniture goes up in balance. All right, saving new. Next, we have a return receipt. We return some items from our professional library. Again, let's stay on this interface. It takes one click to reverse everything, right? So there it is. We're returning it to Professional Education Solutions. Reference number. Professional library right here. What's going on here? Well, you know that when we return something to, in this case, Professional Education Solutions, they will, whatever the money we paid for that item, they will move that money back to the credit card company. Therefore, our balance will be reduced with the credit card company. So it's almost like a payment. Liabilities are reduced when debited. So this whole amount, $851.25, will be debited to our credit card amount balance and therefore reduce it. And liabilities are reduced when debited. Okay, what else is happening? Well, our assets will be reduced as well. We had this one book that turns out we don't need. It was previously included in our professional library balance. Professional library is an asset. Now we're taking it out. Since we took it out, assets are reduced when credited. We need to credit 14,000 account, and that's what we do. So this amount right here is a credit to account 14,000, and this account amount right here is a debit to account 22,100. Save and close. Right. That does for the transactions. Now we gotta make a payment, right? So now we will pay. We will pay from our bank account to our credit card. We can do it with the transfer. We can do it with the check too. Perhaps we'll do it in the following quarter. We'll kind of switch it up quarter by quarter. All right, so general account, moving it to our credit account. All right. All right, what are debits and credits? So again, just like the return, the payment reduces our liability. So similar, debit, our liability. There it is. All right. Well, in other assets is reduced. In this case, it's our bank account. So there it is. All right, so this amount right here, it is both a debit and a credit. It is a credit to account 10,100 and it is a debit to account 22,100. All right, and that concludes processing transactions and payments for our credit card for March. All right. Then we have some transaction we got to book for our vendors that we pay with checks, and then we get to reconcile. Please stay tuned. We have much more exciting stuff coming up.